Recording in progress.
Hello, and welcome to Canadian Tax Matters. And thank you for joining us for today's case on the 2021 federal election tax policies. My name is Jay Goodis. I'm the CEO of Tax Templates Inc. and the co-host of Canadian Tax Matters. With me here again today is the finely dressed Kim Moody, CEO of Moody's Private Tax. Kim, how are you doing today?
I'm doing great, Jay. You?
Doing fantastic. Excited for today's session.
Me too.
And we have a special reason to get excited. We have a very special guest with us today. We have Jamie Golombek with us. Hi, Jamie.
Hi, how are you?
Good. How are you? Thanks for being with us.
Pleasure.
For those who don't know Jamie is the Managing Director of Tax and Estate Planning with CIBC in Toronto. He is one of Canada's most well-known tax experts, and he is quoted frequently in the Canadian media as an expert on taxation. He writes a weekly column called Tax Expert in the National Post. He's appeared as a guest on BNN, CTV News, and CBC's The National, and has been a regular personal finance guest on the Marilyn Dennis Show. Jamie is also the recipient of CPA's Ontario Award of Distinction, and he is a fantastic person and knows a lot about tax. So we're really happy to have him with us.
Pleasure.
All right, so we got the...
Pretty excited. That's awesome, Jamie. Thanks for doing this.
Pleasure.
All right, so it's election time. The 2021 Canadian federal election, it will take place on September 20th to elect members of the House of Commons to the 44th Canadian Parliament. Advanced voting starts on September 10th. So I think the best thing to do before we jump into the new platform is let's recap some of the major tax policies over the last several years. Perhaps we can start with some of the major programs introduced as a result of the pandemic, such as the CERB and the CEWS. Perhaps, Jamie, you can start by sharing us the status of these programs.
Yeah, so these polls are ongoing, to some extent, and I mean this will be a critical thing, I think, for any party to figure out, post the election, because as we know, we've talked about this amongst ourselves and among certainly many in the tax community, is that these programs certainly got launched very, very quickly, and kudos to the government for being able to really launch them, on very, very short notice in a pandemic with all kinds of global uncertainty. Yet there are really some serious problems with the design of some of the programs, and certainly I can speak freely certainly about the CERB, the emergency response benefit now replaced by the Canada Recovery benefit. I just wrote an article a couple of weeks ago that I continue to get numerous emails about the whole issue of the $5,000 and the net income and the gross income, and a bit of a mess. But I think the fundamental issue, and this is something that the parties will need to figure out both now and going forward, and we see some of this, maybe we'll have a discussion later on about changes to the EI, the Employment Insurance Program. The real issue, I think, for most parties to figure out is how do you provide support to people who need support, but at the same time giving them an incentive to go back to work if they're able to. And I'm sure we've all heard stories, maybe Kim can comment, certainly in Alberta, we've read a lot of stories about very hard to find workers, because people are still collecting government benefits. And, it's a trade-off between, do you take that minimum wage job in retail or in the service industry or in the restaurant business? And we know there's incentives for restaurant business that we'll talk about a little bit later. But, how do you get people to take those jobs when it's almost the same or almost as lucrative, or, maybe you collect some government benefits, you don't work as much. So this is a real issue. And I think this is something that all the parties really need to figure out, is to that balance, to providing that support for people who really need the support, yet at the same time trying to encourage people to go back to work. One final thing I'll say on this is my biggest concern with the whole program is that, to me, it's ludicrous that people should have been able to make more money on the recovery program than they made the previous year. In other words, if the income test was $5,000, why did people get to collect $14,000? That, for me, is a fundamental misunderstanding, in my knowledge, on why the program and how the program is flawed in design. I'm hoping that any future program would limit, the type of recovery that one can get to one's income either last year or the previous year or some kind of average. So I can go on and on about this, but I think the government, any future government, really needs to figure out the incentives, not just for personal, like I've just talked about, but even the business, like the wage replacement and the queues, which has really been a lifeline for some businesses, but in terms of encouraging businesses to rehire their employees.
Yeah, I think that's a really good overview. And what's great about having the platforms in front of us, we can see what the parties are recommending, and we're going to look at those shortly and compare what the different parties are planning to do if they are elected. So we'll circle back to that shortly. But Kim, maybe I'll pass it on to you now, because we've had some major tax policies from the federal government that have had a significant impact. Perhaps can you share some of the policies that have shaped the Canadian tax system over the past few years?
Yeah. It's been, I have trouble remembering a time before COVID. It's been that kind of craziness in the tax world and the changes that have happened. But, as the slide here indicates, these are the top ones. We had some CPP changes, large enhancements, the tax on split income rules, which of course were hotly debated and battled and came into force January 1st, 2018. Very, very difficult legislation. The passive income rules, which are not as complex, but certainly have had an impact for private corporations who have passive income. The employee stock option rules, which have been, they were on, they were off, they were on, and looks like they're still on, and we'll see exactly the legislation, if it gets passed. My opinion, the recent amendments are. I just don't agree with the stock option rules but having said that, not a bad compromise, what they've come out with in the whole scheme of things. The intergenerational transfer stuff that came out of the 2017 private corporation stuff, where they announced that they were looking at ways to legitimize, if you want to, legitimize not the right, allow for intergenerational transfers that were legitimate to not be subject to the anti-avoidance rules. And of course, our last session that we had, Jay, we talked about Bill C-208 and all the, what's good, what's bad. There's lots bad in it. And so certainly we're going to see some changes come out of that by the end of the year. And then GST on digital products, that is so-called digital services tax, short-term rentals, to catch the Airbnbs and things like that as well. So no shortage of changes pre-COVID, but God, Jay, it seems like eons ago that stuff like this we were talking about. So the stuff that Jamie was talking about has certainly been front and center for the last 18 months. And so there you go.
Yeah, absolutely. That's a good overview. And we're going to see a little bit about the employee stock option rules that the Conservatives are actually making a small tweak to as part of their election platform. We'll see that soon. Now, I'm sure everyone's aware that we did have a budget recently. On April 19th, we had the federal budget, and some of those policies have been legislated. They were legislated in June before the House rose for the summer. However, there are a few key policies that may or may not proceed based on the outcome of the election. Jamie, do you want to maybe discuss some of the key pending tax policies?
Yeah, I mean, a couple of the big ones here. You got a list on the screen. We don't have to go through all of this for all the viewers, but certainly the luxury tax has gotten a lot of attention. It'll raise very little revenue. I don't remember the exact number, but it's not a big deal. But it's certainly political in terms of people who can afford these boats and cars or things like that should be paying a larger percentage of tax. We're telling everyone buy your boat before the end of the year, right? It's that simple, right? But we'll see what happens with the election. But I agree, depending on who gets elected, this may or may not go forward. The OAS is a popular one. We've started to see the money came out already this summer. That sort of 10% boost, that one-time payment went out to many people, and judging by the emails I got, it was very popular, well received. Of course, the people who were 74 were very unhappy. They were discriminated against. Why didn't they get the one-time payment? Anyway, they'll get it next year. So that's certainly very helpful, but there's some controversy there as well. But I think that's already a done deal. So I don't think we're going to see any change there.
All right. And Kim, how about you for any of the pending tax policies? Is there a specific policy you'd like to see implemented regardless of the election outcome? The one that I talked about previously, Bill C-208, I really would like that
to be clear in tax policy. Like, what are they trying to achieve? I think it's obvious what they're trying to achieve, but certainly the legislation should mirror that, which right now it doesn't. So regardless of the election outcome, I hope that whoever forms the next government will take that very seriously and move that forward. I will say just very quickly before we move on, I know we've got lots to talk about, but the last bullet on this slide, immediate expensing of up to 1.5 million, that came out of the bit of a surprise in the April budget of this year. I've been hearing, and Jamie, I'm not sure if you have or Jay, from some peers in the tax community, that the CRA is denying some of the deductions right now. So I haven't seen that, certainly in our client base yet. But if you are seeing that, and the reason why is because the legislation hasn't been passed. So I can somewhat understand if the CRA's views on that. But in any event, just a heads up for people that are perhaps experiencing that.
Yeah, absolutely. Thanks for mentioning that, Kim, because it is something we've seen in the tax community. All right, so let's move on to the platforms, and let's move on to the economic recovery. And this touches on what you were speaking about before, Jamie. We're currently in the fourth wave of the pandemic, and restrictions are still in place across the country for businesses. And there's also travel restrictions. With the challenges still facing businesses and employees, all of the parties have released some policies to support this economic recovery. Perhaps you could take us through some of the highlights of each of the parties.
Yeah, I mean, we could talk briefly about a couple of these things, the Liberals have proposed. I mean, in terms of the tourism sector, we know it's been decimated. We're starting to see more tourism now in Canada, which is really interprovincial. Almost everyone I know has made some kind of, interprovincial trip somewhere. All my vacations is somewhere we're actually in the same province of Ontario with some camping and things like that. So, we didn't use any hotels or anything. We used a tent. But that being said, people are certainly traveling around Canada. We're not seeing the international tourism yet. And, what can the government can do? I mean, a lot of it will depend, of course, on the COVID and the pandemic situation and things like that. The arts and cultural recovery program still has not even, began to recover. I mean, now they're starting up. They're thinking of starting up theater productions, for example, in Toronto, where I live. But there's no live theater in Toronto at this point. And there's no, official dates, I don't think, until December. So that's going to take some time as well. And also reduce capacity. Like, I've been going to some Blue Jays games. That stadium in Toronto, the Rogers Centre, holds 50,000. They're limited to 15,000, right? So I don't know if there's a lot of sympathy for the Jays or Rogers or whatever, but at the end of the day, they're filling it up with 15,000, and it's really a great time. Lots of space, it's social distance seating, but these sectors have really suffered. Right? Tourism and arts and culture. And the only other point I'll just mention, you have it on the slide here, just on that previous slide, is that home office expense. You can see my fancy background. That's hiding up a spare bedroom because that's where I've been since March of 2020, March the 13th, Friday the 13th, by the way. March the 13th was the day I started working from this spare bedroom in my home. And there's no plans to return, I don't think, from our perspective, maybe until January of 2022 at the earliest, depending on how things go with the potential fourth wave in Ontario or in Toronto, where I live. But the home office expense deduction, has been very helpful for many people. It was the $2 a day, the simplified method. You don't need the form signed. All kinds of details that were very helpful. And I'm pleased to see that, again, the Liberals have extended that for at least 2 more years. So 2021. 2022, you don't need to track all those, receipts of, all your expenses and things like that. I actually just got it audited on my home office expenses a few weeks ago. I got a review letter from CRA, and they want to see, because I use the detailed method, and because, mathematically that worked better for me than the $2 a day method. And they want a copy of my home floor plan, which I do not have. So we'll see what happens as that audit progresses. But, at least on the simplified method where it works for most people, I think most people took that $2 a day method. They've now proposing at least to include that in the 2021, 2022 tax years. And then they're bumping that up. It was $400 maximum to $500, which is really not a big deal because remember that last year, 2020, the pandemic started March the 13th. So you didn't have those January, February, and March days where you're working from home. So $2 a day for the 200 working days was $400. Now you have 250 working days. It's $500. It kind of makes sense, right? So I think that'll be very helpful to a lot of people. And I think it certainly makes sense. And actually, when you do the math, for most people, not everyone, for most people, the simplified method certainly the way to go. And I would expect, just going back to what you were saying, Jay, earlier, that all the parties, even though this is a liberal proposal, that all the parties, no matter who wins the election, majority, minority, whatever, would probably continue with the simplified home office expense deduction.
Well, Jamie, before we move on, just good luck on your CRA audit review letter. And I know you're a hell of a tax guy, but I'm not sure if you're a good drawer. And if you need help drawing your floor plan, Jay has some young kids with crayons. So perfect. Jay, maybe you should offer some assistance there.
Maybe it'll be the picture in the National Post when Jamie writes the article about his experience through this audit.
Exactly.
There you go, Jamie.
Thanks. All right. So what about the Conservatives? Jamie, Kim, do you want to maybe speak a little bit about what their plan is for the economic recovery?
You're on a roll, Jamie, so go ahead and I'll just supplement.
Yeah, again, I mean, you're looking at a number of things primarily aimed at hiring people back, right? They call it the Canada Job Surge Plan, trying to basically pay the salary of new hires for 6 months at the end of the wage supplement, right, which is ending. They've got the details on there. We don't have to go through all the details. They've got this investment accelerator with investment tax credits, for new capital investments next year and the year after. They've got that Rebuild Main Street credit. You might have read a little bit about that. 25% credit on $100,000 that a Canadian invests in a small business over the next couple of years. So kind of innovative policies to try to get the economy going, particularly for small businesses. You've got the Main Street Business Loan again. We've already had the CEBA account, right? The emergency, the loan where I think it was $40,000 and up to $60,000 eventually. So again, similar concept there. We get a 25% forgiveness, this time up to $200,000 for small business. So lots of things there to encourage businesses to rehire. And then the last one's my favorite, the Dine and Discover program, the rebates for food and non-alcohol, of course, drinks for, dine in, but only Monday to Wednesday. It's a little bit of detail here, kind of, teasing people to get out there and start dining. So, kind of interesting.
Well, Kim, I want to actually ask you about two of the programs that Jamie mentioned, the Rebuild Main Street Tax Credit and the Canada Investment Accelerator. What do you think about those from a tax policy? And maybe we'll start with the accelerator. How do you think that might work with a 5% investment tax credit on capital investments?
Well, the devil's in the details, and there's not a lot of detail on the platform, but is it a refundable credit? I doubt it. Can't tell from the platform. But this goes back to our tax credits, through administered through the tax system versus a rebate. What's better? And I think this debate will go on forever, and I'll probably be long in the grave before something is resolved on this. But from a selfish point of view, I'm never a big fan of these kinds of credits being administered through the tax system. It just complicates it. Having said that, the alternative is to hand out grants outside of the income tax system. That comes with a bunch of cons as well, picking winners and losers, for example. So I understand what the Conservatives are trying to do here, and some of the other parties as well, and I commend them for that, because certainly Canada needs a push and a support for business. But I think it's up for debate as to whether or not the tax system is the right place to do it.
Yeah. Well, how will this policy differ from the immediate expensing of CCA? Or do you think they're just similar, just provided a different way?
I think it's similar, but in a different way, obviously. The $1.5 million of expensing of capital assets is of course trying to encourage businesses to expand or to replace their equipment that perhaps needs to be replaced. Versus the Canada Investment Accelerator, as I understand it, is to and I'm sure there's going to be caveats around this. I'm sure the 5% investment credit is not for real estate, would be my guess, because that's usually a no-go zone. But very, very similar, I would imagine, in terms of policy, but it was certainly very different in terms of details, would be my guess.
Yeah. Well, your real estate comment, I think, is a nice segue to the very next one, which is the Main Street tax credit, because I think there's some concern that a lot of individuals might be investing more in public markets, cryptocurrency, and real estate. And it looks like there's potentially some encouragement to invest that money in small businesses. Is that how you take the Main Street tax credit? And do you like this policy? Jamie, Kim, either one of you can jump in.
Well, I'll jump in and Jamie can tell me I'm wrong here, but as usual. I like any encouragement for small business. Small business is a huge employer, of Canadians, and it's critical. In my view, it's critical to support and rebuild small business for the COVID recovery, post-recovery. And so ideas like this, I commend. And the other parties have ideas as well. Again, do I think that the tax system should be the way to administer these kinds of enhancements? Perhaps not, but it's certainly an idea. That's probably where I'll leave it. Jamie, what do you think?
Yeah, look, I like the idea. I think we have to be very, very careful about the risk of abuse, right? When you start getting invested in these private businesses and many, many legitimate businesses that really could use the investment. But it's, again, also very easy to set up, these short-term businesses with friends and family members, and you get money in, you get a credit out, then the money flows back in a circle back to you or through some numbered company. I think you just got to be very careful. I like the idea, I like the policy, but we got to be very, very careful that it's not abused when you're getting a credit for an amount that you invest. I want to see how it's drafted. I think that's the most important thing I'll say about that.
I totally agree.
All right. Perfect. So let's keep on moving. Let's talk about the NDP. So they have an economic recovery plan as well. Jamie, you want to quickly take us through it?
Yeah, again, without knowing too much of the details, again, the same concepts, right? Extending wage subsidies, rent subsidies, things like that. I think the rent subsidies are really, a much more open-ended question as to whether they actually work in terms of, getting the money right back to the people, whether it's the landlord, the tenants, the business owner. Yeah, it's a little bit more complex. Certainly, some good policies there. This idea of paying the EI and CPP, we do hear obviously that payroll tax is a concern. I don't think this is big dollars there, so I'm not sure that's going to make a big difference. And again, we probably won't even go there today, but this whole debate of the minimum wage and what it should be, and should that be regulated, should that be enforced, and that's a much broader discussion, which I think politically we won't get into today, but certainly an interesting proposal by the NDP.
All right. Thank you, Jamie. All right, so let's move on to some innovation, because we know, especially during the pandemic, we've seen a lot of businesses move online. We've seen a lot of innovation in the digital world, and there's a lot of demand that this could be the future of the Canadian economy, and we need to invest heavily in it. Jamie, are there anything that was promoted in the policies that you thought was interesting on an innovation front?
Yeah, I mean, look, lots of interesting ideas here. The one that stands out for me, of course, is the flow-through shares. We're very used to, sort of in Kim's region, I should say, the idea of flow-through shares, right, for oil and mining and gas exploration, things like that. Big in Alberta, big in Saskatchewan to some extent as well. You don't have a lot of that in downtown Toronto. That being said, the concept of the flow-through shares for tech companies, certainly an interesting idea, where the investor essentially puts money in somewhat speculative, I guess, investments with the startup tech, and we don't have all the criteria, and they essentially get a tax deduction for the 100% of the amount that they invest in the year that they invest. And of course, their ACB goes to zero, so if there's a future recovery, it's taxed as a gain. But it's really a way of incenting people to invest in these type of startups. So it's an interesting idea. It's trying to move away from the oil and gas mining only type of flow-throughs into a new concept, and saying, where do we want some of this money to flow? And maybe it's tech, right? So that's kind of an interesting idea. And then, as Kim alluded to earlier, this idea about slightly tweaking the stock option rules. So we know that on July 1st, as of this summer, we have new rules for stock options, for newly issued stock options, which effectively tax anything over $200,000 of option benefit in a particular year. And it's complicated based on the value of when it's issued and all that, but effectively taxes it like straight income. You no longer get that what's called the 110(1)(d) 50% deduction for amounts above the $200,000 benefit. And what they're going to do, of course, is exempt any Canadian-controlled startup with a headquarters and a minimum test of two-thirds of their employees in Canada from that plan. In other words, effectively allowing them to remunerate the executives, the founders, things like that, with this very attractive stock option benefit of the 50% deduction. So those couple of things stood out for me.
Yeah, thank you, Jamie. Anything that you want to speak about on the innovation front, Kim, as well? And I think something that we both noticed by the Conservatives and the Liberals is they're both looking to make amendments to the SHRED program, which has been something that's been discussed for many years. And we have friends who've been promoting new ideas for the SHRED program. Do you think that's a good idea?
You asking me, Jay?
Yeah.
Listen, I'm probably not going to win a lot of friends who are in the SHRED community, but I do think it's time to take a close look at the SHRED program, whether or not the tax system is the way to do it. I've said this over and over again. I do not necessarily agree with some of the rhetoric that's in some of the parties' platforms about, that it benefits just strictly the promoters of these programs. I think that's a bit exaggerated. But having said that, are some of these promoters or advisors in the SHRED program highly remunerated? Yeah, sure. But they do a good job for some of them as well. Is there abuse? Yeah, there probably is. But all to say that I'm a big fan of taking a look at status quo, especially if status quo has been around a long time and the SHRED program has its pros and cons. And I think it is time to take a peek.
Yeah. And I think something that's really interesting about, if we look at the Conservatives versus the Liberals in terms of innovation, the Liberals are using a lot more funds. They're funding things through grants where you can apply to get funding, where the Conservatives are using a little bit more through the tax system. You touched on this briefly, Kim, but can you maybe expand about what's the difference between the two approaches of one using the tax system and one more funding set up that can be applied for?
Well, we using my home province as an example, we had when the NDP were in power a number of years ago now, they introduced a tax credit for startups, and I'm oversimplifying it, but the problem with that, and it was administered through the tax system, but the problem with that particular program, which was unusual, was that it was still subject to the approval of somebody that was picking winners and losers. Whereas in many programs that's administered through the tax system, as long as you meet the criteria, you get it. And so I think that's one good thing of administering through the tax system. You meet the criteria, you file, yeah, you may be audited, but you're going to get your credit, whether it's refundable or a reduction in tax. So versus a fund, has a lot more, application process, review. Maybe there's winners and losers that are picked. Is it a lot more administrative cost? Perhaps. And so I think there's pros and cons on both. I'm not sure that I totally have a favorite because I do see pros and cons.
Yeah, absolutely. I think it's just very important to understand the differences between the two approaches because both parties are trying to address the issue. They're just addressing it in different ways. So it's helpful to understand how they will work as people make decisions on a go-forward basis.
Yeah.
All right, great. So let's jump to students and education. Jamie, do you just want to maybe share a little bit about some tax credits that might change as a result of the election outcome?
Yeah, again, we've listed here on the slide from Liberals' proposals. They're all sound things. Certainly, students need help. I've got two kids right now that are students in post-secondary education, and certainly they can even despite summer jobs, which they both had this summer. Obviously, they could use help. Fortunately, I had the RESP, but of course, if you haven't saved in the RESP, of course, students certainly need help. If they don't have funds available there to supplement, for spending money and things like that. Not to mention, of course, if they're living away from home. So again, a lot of these things are helpful. I think that's an interesting one is the permanent elimination of the interest on the kind of student loans, right? So again, we get into this whole issue every year, which is really just a nuisance. I'm sure Kim's seen this as well, where you get the issue of interest deductibility and you're eligible for the student interest credit, right, for the student loan, but only if the loan is available under the Canada Student Loans Act or a provincial equivalent. Whereas, if you're at a bank and you make a loan to a student under a student line of credit, of course, the interest is not eligible for that particular tax benefit. Of course, if you eliminate interest altogether, you solve the problem. So, interest rates are relatively low. I like this policy. I think it's something that's interesting. And again, this other one bugs me. I mean, not to be overly critical, but this is the eligible educators school supply credit. Again, this is a real issue. I know certainly many teachers that pay a lot of money from their own personal out of pocket to pay for art supplies, teaching supplies for the classroom. So, I have no problem with it. The problem that I have, and Kim and I have talked about this on previous occasions, is this just is another boutique tax credit. In other words, you're bumping it up. Now it's a refundable credit. It's going from 15 to 25%. We're not talking a lot of money here, right? We're talking, $100, couple $100 here. And, in the end of the day, as I've said many, many times, I would really do away with most of the boutique credits other than the basic personal amount. And I would either lower the rate for the first bracket, maybe by even 1%. So if you got the first 40,000, lower that by 1%. There's right away a $400 benefit for everybody, right? Or bump up the basic exemption a little bit, across the board. But I don't really like these boutique tax credits. And if I can just personally digress for just a second, in the audit letter that I got a few weeks ago, auditing my home office expenses and asking for a floor plan of my home to deduct the right amount. They also asked for proof of my digital media credit. Now, I write for the newspaper, but I have to pay for it myself. So I do have an online subscription to the newspaper, and I get the other newspaper as well to see what both sides are saying. And, the total amount is $500, which at 15% is $75, right? We're not talking big money, but I got a list of 5 different things they want to see: the credit card, the confirmation, the subscription, what they did do, what is print, what is digital. I mean, what a mess. But I'll respond on principle and see how it plays out. But at the end of the day, that's $75 of value to me. And same thing with these, sort of boutique credits, these, eligible educators, school supply. I can't remember the amount. Was it $1,000, something like that?
Yep,
This is not $1,000, right? So $150 we're talking, going from $150 to $250, and you need the receipts, right, for all the expense. I mean, it's ludicrous in my opinion. So nothing personally against the Liberals and this particular credit, and certainly nothing against teachers, who are probably the most undervalued of almost everyone in the economy for the wonderful work they do. There's no doubt that they need the credit, but wouldn't it be better to get rid of all the red tape and administrative hassle associated with all these boutique credits and give everyone a break by lowering the rate for everyone?
All right.
I couldn't have said it better, Jamie. So these boutique personal tax credits, I don't care which party is proposing them. To me, it's just politics. Yeah, and I understand that you need to get votes and what have you, but at the end of the day, they're unnecessary. They clog the tax system. You described it right. $75 for your digital subscription credit. If I were you, by the way, I'd file a protective notice of objection on that one. So in any event, my 2 cents.
All right. And we have a few points here by the NDP as well. They're similar to the Liberal platform. Anything to share on here, Jamie?
Yeah, look, I think it's self-explanatory. They also want to eliminate the student debt interest, a stop to loan payments. I think the Liberals are already doing that, right? Deferring payments, right, on the student loans. Now they're going to cancel student debt, which is a whole nother story. And I think we already have a big debt load, in Canada. But yeah, not really much further to add on these policies here.
All right, perfect. So we'll keep on moving, and we'll go to parental supports. And this is always a hot election topic, which is childcare. So Jamie, why don't you just maybe start by just sharing the 2 different approaches that the parties are sharing for childcare?
Yeah, of course, the big one, of course, the Liberals that they've touted a lot, and it was in the recent budget, is the $10 a day plan, which, you have to some extent in Quebec, to the extent that you can find a place for your kid in Quebec, right? But it's expensive. Like where I live in downtown Toronto, my kids are, much older. They don't have any kind of childcare right now, right? But, I know that in Toronto, I mean, it can be $2,000 a month. For one kid for early childcare, and that's what I've heard. If you can find a space, right, and that's outrageous. Going to $10 a day, obviously, is a lot more affordable, and that's what the Liberals are planning to do. And if I remember correctly, I think we have a slide on it for the Conservative. I think the idea is to move away from the subsidized daycare program and instead introduce a refundable tax credit, basically giving, depending on your income level, giving basically a refundable credit. And the difference here, as I've written about before, is this does provide different types of choice, I guess, among families. So if you decide that you've got a couple of kids and you decide maybe it's better to bring in a babysitter or maybe bring in a nanny to your home, you're not going to use the $10 a day childcare. You have a different method. Of course, under the $10 a day program, it's not going to help you if you're hiring your own private childcare for your home, whereas a Conservative program you presumably would be eligible for a tax credit. Similar to right now, we have the child care deduction, right? It's non-refundable. And then there's strict rules of lower income and 2/3 of earned income and things like that. So this here is kind of enhancing that credit, making it refundable. And then again, on the low income side, potentially covering 75% of the cost for lower income families. So kind of a very, very different approach, along with a whole bunch of other benefits as well that you see on the slide here.
Yeah, I agree that I think each one of these programs have different challenges. If we look at the $10 a day childcare, well, to your point, in Quebec, I am aware that there's a wait list for spots. So the challenge is if you can't access one of those spots and they don't have childcare, then that means some people are getting access and some people are not. So there's kind of a difference in what people are going to pay. But if you look at the childcare deduction we have now, we still have similar challenges because someone who's in a different tax bracket than somebody else will get a different amount of refunds. So even though, or deduction, excuse me. So therefore, regardless of who they pay for the exact same childcare space, they're going to have a different amount they're going to get back. And we see the same thing happening with the conservative approach here as well, is that depending on your income situation, you will get a different amount back. If the lower you are, you get a little bit more. If you get higher, you'll get a little bit less, where again, under the childcare deduction, it almost works the opposite way, where the bigger deduction you get because you are in a higher tax bracket, that's going to lead to more savings. So each one of these situations has different challenges. Kim, is there one policy that you think would work best for childcare, or do you have similar thoughts to Jamie and I that each one of them has their own pros and cons?
Yeah, I'm aligned with you guys. I think both have pros and cons, and by no means am I an expert in this space, but anytime there is the ability for choice, I like that. I think your Quebec example is bang on. But having said that, I'm aligned with all of the comments that both of you have made.
I think that one thing just to add here is that whenever I write about this whole childcare issue, especially after the budget, I do hear from people, and I don't know if it's the majority, it's certainly a vocal minority of people that don't have children, by choice. I don't want children. I think there's too many children in the world. You hear all the different reasons. Why should I subsidize everybody else's children, right? And then you have other people saying, well, I get that I should pay something, but, should I be paying this much billions of dollars to support somebody else's children? And this comes to that whole big, broader question of policy and, our social democracy, right, in terms of supporting the ability for parents to take care of kids for the future generations, to grow the economy, and things like that. So it's a much broader debate here, and I think it does become very political. And I think this will be one of the big issues that people will be voting on, depending on whether or not the voter has children and whether or not the children need the daycare and whether or not the children are old enough to not need the daycare anymore. So I think this could be a big issue for many, many families in Canada. Look, if you've got young kids and you're paying $2,000 a month in daycare in downtown Toronto, I wouldn't be surprised if $10 a day daycare was very, very appealing to your family.
Yeah, I'd agree, absolutely. And the NDP as well, they're also promising a $10 a day daycare as well, so we know what their policy is aligned with the Liberals and what they'd like to achieve. And I think in both cases as well, there'll be the child care deduction will maintain, so if there wasn't a spot available for $10 daycare,
for sure,
the existing system will still continue.
Yeah.
All right, so let's move on to housing. And wow, the cost of living and inflationary concerns are certainly front and center. So housing is at the center of this discussion as home prices have ballooned all over the country, and all the parties have ideas for housing affordability. The suggestions are a mix between tax and non-tax policies. Jamie, I'm going to go back to you, and if you want to maybe share some of the few major tax policies.
So the first one is really interesting one, right? Like first home savings account. And we don't have all the details. There's literally, I was working on a column for this week's Financial Post that'll be out tomorrow that go over some of those. And I spent some time really trying to understand this first one. And again, you only have maybe 7 or 8 lines on the internet that discuss the policy. Only one sentence in the official Liberal platform. But basically, it's kind of a mishmash of the best of both the RSP and the TFSA, as I understand it. In other words, you take $40,000 of your income and you put it into this first home savings account, and you get a deduction on your tax return for the $40,000. So you're not taxing the income when it's earned. You're able to save the $40,000 towards a home. Then it grows, of course, tax-free inside of the account, just like it would in a TFSA or RSP. And then when you withdraw it, and if you read the wording, which I had to double check twice this morning before finalizing my column. You're able to withdraw a maximum of $40,000, which is what it says, which is if you put in 40, you can only take out 40. What about all the rest? I'm not sure. But you withdraw it tax-free. Like a TFSA. So in other words, you get a deduction on the way in like an RSP, a withdrawal tax-free on the way out like a TFSA. And you say to yourself, but don't we have this already, right? Like we have it with the TFSA, but the difference is you pay tax first and then you take it out tax-free. We also have it with the RSP, right, and the home buyers plan, where you put the money in, you get a tax deduction, then you can take it out, I think it's $35,000 now, tax-free under the first-time home buyers plan. Then you repay it back over a 15-year period. In this case, you don't pay it back at all. So interesting idea, but does this mean, like we don't know, maybe you guys know, does this mean that everyone who's under 40 gets $40,000 of free RSP room that us people over 40 don't get? Something's missing, right? So not a lot of details there. I find it fascinating. We'll see what happens there. The other one is small potatoes, right? Like first-time home buyers credit, right? So again, 15% non-refundable boutique tax credit. It's worth $750. Now you're going to get another $750, right? So, now it's worth $1,500. It's supposed to cover the closing costs of a home, things like that. The next one, again, you're looking at, targeting key voters, multi-generational families that, want to put in that extra room to have their parents or, other grandparents move in with them, things like that. Again, it's a renovation type credit. We've seen renovation credits back, 20 years ago. There's a history of that. We now have it for, home accessibility tax credit, right, for people with disabilities, people over the age of 65. So here is the opportunity to, renovate your home and get 15% back. If you can find someone to renovate your home, because that seems to be the one industry, certainly in Toronto, you can't get anyone, right? Because it's just booming. That's what everyone's spending their money on home improvements and additions and, and things like that. And then you're getting into some of the other details, the anti-flipping. I've written many articles on some of the cases that we've seen in the last few years since the government now requires you to disclose the disposition of your principal residence on your Schedule 3, now on your personal return. All of a sudden, we're seeing all these cases where the government is now looking at people flipping. And they're saying, well, you bought it, you sold it within a year. Is that really a business? Is it a principal residence exemption? Is it a capital gain? Is it business income? So here they're going to say, well, we're going to stop people from flipping. We're going to require you to hold it for 12 months. And we have a concept like this in the United States, right? They have this concept of the short-term and the long-term capital gain. Anything under 12 months in the U.S., stocks, bonds, mutual funds, homes, right? Under 12 months, fully taxable as regular income, ordinary income in the U.S. on the U.S. return. Anything over 12 months, it's a long-term gain, taxable at capital gains rates, which right now, at least in the U.S., long-term rates are 20% federally, right? So again, you've got a lot of policies here we've seen. You've got the vacant land tax within large centers like Toronto and Vancouver. We've seen some of that recently provincially as well. So a lot of interesting proposals there. Will it end up doing anything? Hard to say, right? Because there is big demand for housing, in the big cities. We see prices really skyrocketing. They're trying to say that, 40,000, where did they come up with the number? That's basically 5% of an average home of $750,000. Looking at average home, across Canada, certainly in Toronto, you can't buy a home for $750,000. Maybe you could buy a condo.
That was a fantastic overview. Kim, I'm going to let you just jump in if there's anything that Jamie said that you wanted to elaborate on.
The only one I'd maybe just comment briefly on is the anti-flipping tax. I'd be curious, Jamie, to see your thoughts on that or hear your thoughts on that, because the existing act, the Income Tax Act, already has provisions to prevent flippers. And you rightly pointed out in 2016, and I think this was a long overdue thing, that CRA now requires the disclosure of the disposition or the claiming of the principal residence exemption. Why they had that long-standing administrative rule, for decades to not require it was always mind-boggling to me, because it encouraged people to take the position without disclosure of a claiming of a principal residence exemption. So I see a lot of problems with the anti-flipping tax having an arbitrary 12-month shutdown. I know in their policy document they disclosed certain life events that would be exempt from that, like divorce, death, what have you. But I just think the existing act has provisions to prevent flippers. I'm not so sure that we require this arbitrary 12-month rule. I disclosed some comments on my personal LinkedIn account on this probably about 3 weeks ago. I think it has the potential to litter the courts with and cause behavioral responses that may not be so good. So anyhow, I'll just leave it at that.
I think what they're trying to do, though, is they're trying to, as you pointed out, I think they're really trying to carve it into legislation and say, you know what, anything less than 12 months, we don't care what the reason is, unless you can prove that you fall one of these exceptions, you're hit with this anti-flipping tax.
Right.
Basically, just don't do it because it's an automatic high tax on this flip, right? Whereas, currently right now, you've got a subject to the facts and you can have short term and 7 months. Why, you've read the cases.
Yeah.
There's cases recently where, I moved in here, when I was in there, the backyard was too noisy and I didn't like it. And therefore I moved after 7 months. But then they did the same thing. It was just a great case. I think it was last year. I wrote about it where someone, I think, moved 3 homes in 4 years and each one of them had a different reason. Didn't like the backyard, didn't like the neighbor, it was too noisy, it wasn't suitable, it was too far from the school. Like there were 3 good reasons. And so it's interesting. I think they're going to get away from that. If they put in a hard and fast rule for anything under 12 months, then that's it, right? And you really have to prove, divorce or some relocation or something like that.
Yeah.
All right, so do both of you see this anti-flipping tax being in addition to the capital gain rate that would already be applicable, or do you think it would eliminate the capital gain rate, just a special anti-flipping tax?
Could be both. I'm not sure. I think they want to tax the gain as an economic, but they also want to put in a deterrent, in addition to the gain, right? Gain would be taxable anyway. It wouldn't be a principal residence unless they could argue it really was, right?
Yeah. What I debated on, because there's just not a lot of details, and I don't know, maybe you wrote on this, Jamie, and I missed it, but would the anti-flipping tax effectively be a just tax on ordinary income?
I think it has to go beyond that, right? I haven't seen it, but maybe it would be some kind of punitive tax, like they have with TFSAs, where if you conduct a business in a TFSA, the anti-tax is 100% of the entire profit. So it could be something as harsh as that, just as a deterrent, right? They don't expect anyone to actually do it, right?
Yeah, good point.
All right. I'm going to keep us moving here because we have still a lot more content and not much time left. But the Liberals have a few other proposals here. I think the one that kind of jumps out to me is the reviewing the tax treatment of large corporate owners. And I believe the concern there is that there might be a lot of big businesses or hedge funds that are scooping up a lot of residential real estate. Is there any concerns or any thoughts you have about that policy, Kim?
I do, but again, the devil's in the details. Large corporate owners that own real estate, for example, REITs, are in a position to, access capital and buy residential real estate and rent it out. And there's a big demand and big need for that. And if you tax those particular large owners, what does that do? What's the spillover effect? What's the impact on ultimately the residential renters? And it's not as simple as just paying a tax and think that there'll be no behavioral responses or no impact to the renters. And so the devil's in the details, and I do have some concerns about what that ultimate impact would be.
All right. Great stuff. All right, so let's move on to the Conservatives. And Jamie, do you want to maybe share a few things about the Conservative plan that sparks your interest?
Yeah, well, I mean, look, this whole issue of foreign ownership of Canadian homes for 2 years, this is a complicated one, right? Like the policing of that, there's so many ways around it. A lot of foreigners have, of course, people have immigrated to Canada that are relatives and family members, and it's so easy to, I think, get around some of these rules. So I'm not sure that that's going to make a big difference. Certainly, anecdotally, we've seen that a lot of the foreign ownership is really on the high end of the market. In the multi-million dollars, where you're seeing people from overseas parking money as a store of value, right, in large homes, particularly in the Toronto and Vancouver area. So, I'm not sure, how that would work exactly, or if that's really going to help with housing prices, which I acknowledge is certainly an issue in big markets like Toronto or Vancouver. So, a bunch of other stuff there as well. I don't know if Kim, you have any comments on the other stuff.
No, not really.
Yeah,
I know we're running short of time, so.
Yeah, I think the Liberals also have a ban on foreign ownership for 2 years as well. So it's something both of the major parties are looking at.
Yeah.
And for the NDP here, Jamie, I'll let you.
Yeah, same thing, right? Like they've got that 20% foreign buyers tax on homes, but again, homes sold to people who aren't Canadian citizens or permanent residents. Again, very hard to police that, very complicated, and obviously that would deter someone. But I just don't see that practically speaking.
Okay. All right, so let's get to the new taxes, because we're doing a lot of spending and a lot of credits and programs. We talked a lot of the benefits they're offering, but what are the new taxes that are going to be released? Kim, why don't I pass it on to you to share some of the highlights of the Liberals' new taxes that they're proposing?
Sure. The first one, this one kind of came out of left field when the policy document was released by the Liberals about a week ago, I guess. Where they're creating a minimum tax rule so that everyone who earns enough to qualify for the top bracket pays at least 15%. What's on the slide there is about all we know. but what's surprising to me though is that maybe the average person doesn't know that we already have a minimum tax, and it's been around since 1986, an alternative minimum tax, and it is a pain in the ass because it's ultimately designed to pay a minimum tax if you claim discretionary deductions, certain discretionary deductions, but it's refundable over a 7-year period to the extent you're not subject to the AMT recoverable. So what are they ultimately trying to do here? Not really clear. Although there was an article in the National Post by a fellow Alan Lantier who speculates that maybe what they're trying to do is try to shut down the claiming of charitable donations, so that ultimately if you have a high income earner that makes a large charitable donation and reduces their tax to something less than 15%, that the charitable donations will be targeted. And if that is what they're trying to do, then I think that's littered with a bunch of issues. So that's the highlight one. Devil's in the details. We'll see what happens. Of course, increasing corporate income tax rates by, from 15 to 18 for banks and insurance. I won't say much more than that because, of course, our illustrious guest here is from CIBC, but I think that does come with some significant fallback or, trickle down effects. So I'll leave it at that. And, some of the others, we've talked about the anti-flipping tax, new provisions for digital platforms to pay associated contributions, CPP, the luxury tax, which Jamie already talked about. And that's probably kind of the highlights on that, Jay.
Yeah,
I would just add on the AMT again. I'm also at a complete loss. I'd love to see an official government explanation as to what they're getting at there, and if I'd be surprised if it's donations. You already have a limit on donations, 75% of net income, right? So that really, I'm surprised. There must be something that you're getting at that we don't know about, and I'd love to hear what it is. So I find that bizarre. And again, there's not much I can say on the bank side, being from a bank, but we do have to remember that, of course, that the excess profits, which are paid out as dividends, and dividends are paid to shareholders of the banks, which is almost every Canadian that owns it either directly through a portfolio or owns it indirectly through their pension plan and other types of things. So it's an interesting area, but can't really comment further on that one.
And I think when it comes to the first policy with the 15%, there's also a question about carry forwards. If there is a limit that they put through this policy, are we going to have a carry forward balance for future years, or is this just going to be denied and can't be used again? So there's definitely some question marks about the first scenario, and we see a Liberal minority or Liberal majority. Maybe we'll get more information about it. All right, so let's maybe jump down to the Conservatives. There's not a lot of new taxes in the Conservative platform. Jamie, you just want to talk about the tech companies, because this is something that's been on the radar for several years now.
Yeah, so they're worried, and we've heard a lot of buzz about this, right, in terms of the digital taxes, services tax, 3% gross revenue tax. The concern is that you've got a lot of these global companies that are not operating in Canada, and how do you tax the services in Canada? And so this is sort of a global approach. So, it's interesting. I think it will happen one way or the other, because you do have global companies that are earning revenues in Canada and not paying any Canadian tax. So this digital service tax, I think, is a reality.
Yeah. Yep. And the Liberals are proposing that as well. So I think we're going to see that regardless of the outcome of the election.
Yeah.
Okay. And the NDP, you also have a few policies here. And Jamie, I'm going to go back to you again.
Yeah, this is a hot one, right? We could talk for hours on this, but I mean, there's no point. I mean, NDP is not going to form the government. That being said, the reason why I think it's important, and I've included this in my column, is that if there is a minority government, probably a liberal minority, but even a conservative minority. I mean, not that the conservatives would ever side with the NDP, but you never know. But these are at least, these are certainly policies that are out there that should, concern some people that are not in favor of high taxes. So, the capital gains inclusion rate, it's 50%. They want to bump it up to 75%. The top marginal rate federally is 33%. They want to bump it up to 35%. That means, provinces like in Ontario and BC, where I live in Ontario, you're talking about a top rate of 55.5%. Nova Scotia would be up at 56%. So these rates are pretty high. So they would bump that up. But we already have this, proposed luxury tax on the yachts and the jets and things like that. And then, of course, the most controversial one, I think, which has very unlikely to pass, is a wealth tax. I think there's only 4 countries left in the world that have a wealth tax. Very, very complex issue. I think the report came out a couple days ago from the parliamentary budget office. It would raise like $60 billion. It was a very large number. I don't know if that's the right number, but it was a large number over a decade or something. And so it's big money, but very, very complex to administer. Like, what is wealth? Yeah, we can value to some extent, stocks, bonds, mutual funds. That's pretty easy, right, to do. But how do you value your small business? How do you value your farm? Do we need valuations? What about the artwork? What about all your Bitcoin? Things like that. So I think from a practical perspective, it'd be very hard to see any type of wealth tax in Canada. But if there's anything that I would take out of the NDC policy, it is the capital gains inclusion rate and the top bracket rate. And I wouldn't be surprised that if the Liberals did form a minority or a majority, that they would take a page out of this, because we have seen the history of higher tax rate on high-income Canadians in the past 6 years or so of Liberal government. I'm sure Kim's got some comments on this as well.
Yeah, no, I totally agree with you. If the NDP, which it looks like they will, form the balance of power, then these things become relevant. I tend to agree with you on a wealth tax. I just don't see it happening. The excess profits tax, which is the first bullet on the slide here, in my opinion, is just not going to happen. It's littered with legal issues and policy issues. But the one that concerns me is the increased inclusion rate and the personal tax rate increase. And so I guess time will tell.
Okay. Do you think, in light of the potential capital gains increase in the U.S., could give it more merit to potentially increase the capital gains rate here in Canada?
Sure. I mean, there's a proposal by Biden, right, to bump it up for the high-income earners for sure in the States, right? So, yeah, I wouldn't be surprised if that would happen. And, look, the average Canadian doesn't pay any capital gains tax, right? Not because they don't have any money. It's because all their money is either in their home, which is covered by the principal residence exemption, or it's sitting in an RSP or a TFSA. So it really is. I mean, even you've seen different reports come out in the last couple of years, but if you really look at the numbers in detail, most of the capital gains tax paid by the top 10%.
All right. That was a great discussion on the different taxes that we can expect, depending on the outcome of the election. All right. So ending off here, we really have just 2 more issues. One is there's lots of other deductions and credits, and I think maybe we'll skip these boutique tax credits just for the sake of time. But just note that they are on the slides for anyone who's interested in seeing which credits are being implemented. I think one thing that we should talk about is potentially the new EI system that all the parties are talking about. And in light of the pandemic, we saw how the self-employed really impacted because they don't have EI, similar to employees. Do you think now is a really good time to be looking at the EI system and implementing new policies to protect this demographic?
Yeah, I mean, look, we could do a whole webinar on this, right, alone. I'm not the right expert for it. There are social policy people that are much more skilled in this area to speak than me. But it is a serious issue. We saw this because people who were self-employed, a lot of contractors, like even techs, for the entertainment industry, music techs, things like that, supporting live entertainment, they're all decimated. They really lost all their income. There was really no income, right? The problem is they have no EI, right? And the reason why they don't have an EI is because, how can you, EI is if you lose your job. So if you're self-employed, and you have EI, and then you fire yourself. Like, it's very hard to, sort of adjudicate whether or not you should be collecting government benefits by firing yourself or not working, right? So there needs to be a solution, and I think a solution where we have some type of, self-employed voluntary contributory system where someone who is self-employed does contribute a certain amount for a certain period of time, so that later on, if they do have suffer a loss of income, there is some kind of income support. But you got to have very tight rules on this. And again, just like with the CERB, and I said at the very top of the hour, there's a lot of abuse going there. And not abuse, really, but just taking advantage of what I think is poor government policy. If someone made $5,000 of either net or gross, or you tell me what it is, to be able to collect $14,000 the following year, to me, is nonsensical.
Yep. That's a good overview there, and I agree with you. It's something that we should probably look at. And if we just jump to the Conservative platform here, the first point of the slide I know is something that's very passionate to Mr. Moody, who's with us, about a comprehensive review of Canada's tax system. This was something that many of us were pushing for before the pandemic. Because of the pandemic that just happened, are you still in favor that now is a good time to do the comprehensive review, or do you think we should maybe wait a little bit longer?
No, I think this is a great time, especially when we're dealing with a whole bunch of uncertainty and the requirement for modernization of our tax system. So I'm pleased to see it in the Conservative platform. I'm a little bit surprised that we don't see it in the other parties' platforms. But yes, I think the timing is certainly correct.
And I would agree. I think it's long overdue for, I don't know if we need a full Carter Commission type thing, but we certainly need to look at some very strategic areas of the tax system. Certainly on the personal side, I would love to see a real simplification, especially these boutique credits, which I've been, complaining about for 20 years.
Yeah, totally agree, Jamie.
Perfect. So we're all in agreement that a comprehensive tax reform would be good for the country. All right. So I know balancing the budget isn't necessarily a tax issue, but it is potentially a tax issue because it might reduce the amount of tax benefits that we could have in the future, or it could raise tax rates in the future. Jamie, just want to give us a quick update on everyone's plan to balance the budget.
Yeah, well, look, I mean, at the end of the day, I think most people do want a balanced budget, but at the end of the day, right now, at least, interest rates are zero, or effectively zero, right? So it's not costing us anything. The key, I think, in my view, is to control the spending, but ultimately to improve the economy. Like, let's get the pandemic behind us. Let's get people back to more full employment, and the revenue will be generated by itself through personal and corporate income tax, through profit. So I think that's the way out of this whole thing.
All right. And Kim, I'm going to give you the last word today. Depending on who wins the election, and we've seen a lot of policies, once we have the final results, are there any proactive steps businesses and individuals should consider before maybe these new policies be implemented, which most likely will come in the fall when we have the fall update?
Well, that's a loaded question. I don't know how to answer it succinctly, but I'll just say that, taxpayers, depending on who gets elected, should be aware of the tax policies that we've outlined today of each of the parties. I like Jamie's points about the NDP holding the balance of power if it's a minority government, because that could form some of the ultimate negotiations that happen in terms of getting tax policy through. And I think taxpayers ultimately need to be mindful of that this is a fast moving area and be proactive in whatever situation you're dealing with. For business owners, I think that means take advantage of the immediate expensing, for example, of capital assets. Are you concerned that tax rates will go up? If so, are there any proactive measures that you can do? If you think capital gains rates are going up, what can you do? If you think principal residence exemption is going away or being modified, what can you do? So I think you need to be mindful of a whole bunch of different issues like that and take proactive steps sooner rather than later.
All right. And everyone heard about Jamie's column, and I read Jamie's column every week in the National Post. So if you're not following Jamie on LinkedIn or Twitter or on CIBC or someone I really recommend following, because there's a lot of great content, and he's going to help keep you up to date on key things that are happening in the tax world. And as you can see today, he's very objective. He knows the facts. He's a wealth of knowledge. So someone I really recommend spending more time following if you aren't already.
And Jamie, hope your drawing skills, like I said, improve.
I'll let you know how the home floor plan turns out.
All right. So for anyone with us today who needs a PD certificate, it is available in the course materials in your Canadian Tax Matters account, so feel free to log in. Otherwise, Jamie, once again, thank you so much for joining us today and sharing with us all your experience and knowledge. It was a pleasure having you.
Thanks, everybody.
Right. And Kim, again, we'll see you next time.
You betcha. Thanks, Jay. Thanks, Jamie.
All right. Thanks, everyone.